Let's have a conversation. Let's have a conversation. Yeah. Let's have a conversation. Oh, yeah. Look. Yeah. Hey. Let's have a conversation. Woo. Pick up some gems, life is all you make. Go. We keep it real, we don't talk to fake. Tell them hottest talk show on the net, coming for all the mates. Let's have a conversation. Woo. Pick up some gems, life is all you make. Go. We keep it real, we don't talk to fake. Tell them hottest talk show on the net, coming for all the mates. I think it's time to have a conversation. Let's talk about it. I think it's time to have a conversation. Let's talk about it.
Hello, everyone. This is Michelle Biggs, CEO of My Best Everyday Coaching and Consulting. Welcome to episode 3 of my Strive to Thrive series. And tonight we're talking about mastering your money and retirement planning in uncertain times. And I know when I started off this year, my view of what my goals were going to be in terms of my finances were very different than what it is right now. And I know some other people are feeling the same way. So we want to make sure that in addition to looking at our health, as well as our career, which would be the next topic, that we're doing the best that we can around our finances. And to me, I have joining me my financial advisor, Mr. Jonathan Chapman, who I will have come on in a few minutes. But first, a couple of housekeeping information. One, this is an educational platform. So like anything else, ensure that you are doing your own homework so that whatever you take from this, if you decide to apply it, you want to make sure that it is right for you. And for those of you who are watching me for the first time, know that my background, I am a master certified life coach, as well as an executive coach and a career coach. So I'm always in this mode of wanting to see people to thrive no matter where they are planted personally as well as professionally. So this podcast was launched back in 2020, and I think many of you can remember what was going on in 2020. So this podcast was a way that I could reach out to people and support people to do just that around a variety of different topics. So without further ado, let me have my guest, Mr. Jonathan Chapman, join me. Jonathan.
Michelle, how are you?
Hello. How are you?
Fantastic.
Good. Jonathan, I'm excited to have you on. I know I have shared with individuals in my circle how excited I am to be working with you in general, because I am not the most financially savvy person at all. So you help relieve that anxiety for me. And I know a lot of people have some questions around what to do, knowing where we are right now and the state of the market. But before we dive into that, tell people a little bit about yourself.
Yeah. Jonathan Chapman, as you mentioned. I am a financial advisor. I am a father. I am a son, a husband. But I'm here today serving in the capacity of financial advisor. I'm with Edward Jones Investments, offices located in Chapel Hill, North Carolina. We currently manage a little over $150 million. We have a little more than 250 clients that we serve throughout 23 different states. And we work with families, business owners, executives primarily, I would say.
So let's talk about the state of the market right now, because I think just to level set people, what are we dealing with right now?
Okay. So I want to give you an update. I also want to make sure that everybody's on the same page and we all understand how we got here. So we can actually go back to 2020 when the world came to a screeching halt. So everything stopped. During that time, we're sitting at home and the Fed, they start to release stimulus. So they're looking to stimulate the economy. They want people to spend again. So a lot of people start to receive checks. Businesses start to receive PPP loans. So the economy's starting to move and we're moving again, right? Money's in circulation and people are spending. So we're spending, and inflation starts to get high. And what I mean by that, the cost of goods goes up. So it becomes a little more expensive for you to go out to eat. It becomes a little more expensive for you to buy a car because at this point, demand has exceeded the supply and the Fed needs to rein that in. And one of the ways they do that is they raise interest rates. So they're raising rates to discourage people from spending because they want to make it a little more expensive and they want to make it uncomfortable for you to continue to spend so they can keep it within control.
Okay.
One of their goals is to control inflation.
Okay. All right.
So
Go.
in
Keep
doing so,
talking.
to control inflation, they've got rates up and they have to hold it because people continue to spend. And it wasn't until last year when they felt comfortable and felt like we were at a place where inflation would not resurge. So they start to lower interest rates. And one of the other things that happened last year is we had a new administration with different priorities and policies that they were looking to implement.
Okay.
Policies would create a possible resurgence of inflation. So now, as of yesterday, the Fed has said that they're going to hold rates as they are because they don't want to encourage people to continue to spend by lowering interest rates.
Okay.
That's kind of where we are at the moment.
Okay. So this conversation is timely, right? Because I think for a lot of folks, I know even for myself, there were things I was planning to do this year that I just said, you know what, I might need to put that off for another year, right? Just so I can make sure I can get to my money and use what I really need to on necessities right now, right? So thank you for that background. So given the current climate, what are the biggest financial challenges people face today?
So, of course, with interest rates where they are, mortgages are more expensive. With housing supply, rent is increasing steadily. Inflation, the cost of living, all those things are, I would say, challenges for people at the moment. If you throw in tariffs, that can make things a little more expensive. So if you need a new vehicle, statistically, it may cost you $5,000 to $6,000 more than it would have a month ago before inflation or tariffs went into play.
Okay.
So a lot of how we live is a lot more expensive for a lot of people, and is pressuring, in addition to the job market is wavering right now because as a business owner, if there's tariffs that go into play, I don't know if I can afford another employee or if I'm going to be able to maintain my margins on my business to continue business.
Right.
So a lot of things are in the air on that. So it's creating some economic pressure, I would say.
And can you talk a little bit about tariffs? Because I know everybody may not understand that in terms of how does it impact me personally as a consumer.
Oh,
can you talk a little bit about that? Yeah.
Yeah. So the simplest definition of a tariff, or the way I would envision it, is it creates a financial wall around the United States of America. That's the intention. And over that, the idea is to discourage money from leaving our country and going over that wall to another country.
Okay.
If you choose to do so, then you're going to pay an additional tax in the form of a tariff.
Right.
That's to keep and make sure the money continues to circulate within the neighborhood of the United States and grow here domestically. And it's also in place to encourage, as a business owner, if you're not on U.S. soil, to replant your roots here to avoid having to pay that additional tax to do business.
Okay.
That's pretty much the purpose of that tariff.
Okay. All right. So there is implication, because a lot of times from what I understood, so tariffs on Canada and Mexico, they're paying that to be able to do business here in the U.S., correct?
We would also be paying that if we decide to buy something from China or, yes, either of those countries. Avocados would be more expensive. Fertilizer would be more expensive if you're getting that from Canada.
Okay.
And it hurts those businesses because it discourages us as U.S. consumers from sending money over that wall.
Got it. Yeah. Makes a lot of sense. So next question. How do people aim to have an emergency fund? And I've been in a couple of different circles where this topic has come up in terms of just having some funding for a rainy day. And it seems like the way the market is going, people are feeling like they need that emergency fund even more established, even more than ever now. How can they build one during times like this?
Right. So to establish an emergency fund, you want to think about the bare necessities or the absolute things that you have to spend money on right now, right? On a monthly basis, you have your utilities, you have your mortgage, you have your liabilities, like your maybe a car loan to make sure you can make it to work. You need food in the fridge for yourself or for your kids. You need to keep the lights on. You need to be able to maintain your housing. All those things are what you want to be sure you've set money aside for. You take that number and then you multiply it, I would say, by 3 to 6 at minimum. Which means if you're spending $4,000 a month to maintain your lifestyle for 3 months, you're going to need $12,000.
Right.
That may not seem feasible for people right now. So you want to think about something that would cause you to have to use your credit card. So maybe a new set of tires. It could be something as simple as starting with $500 and building on that $500 to get to $1,000. And you build it over time. You just want to be able to minimize having to put money on a credit card or to, have a major lifestyle interruption that would cause panic or any type of psychological distress on either yourself or a family member.
Yeah, because even using your credit card right now, even their rates have gone, for many of cards, have gone up.
I mean,
23 and 27% interest.
29%, right? Even with great credit.
Yeah. So, okay, what are some budgeting strategies that can help individuals and families stay financially stable, even in this economy that we're in right now, which feels a little volatile? So, talk a little bit about that.
Yeah. So, in terms of some strategies, what I would say is make sure you are budgeting for your big purchases.
Okay.
Try to avoid going out and just buying something on a whim, right?
Yeah.
Or even when it comes to just big, major financial decisions that create an obligation or a long-term commitment. Try speaking with someone that may be a sounding board, like a financial advisor. I had a client that reached out to me that was looking to purchase a car, and given the state of what I know about the current market environment, I advised him to lease versus buy a vehicle because I knew he would be paying a premium, $5,000 to $6,000 on a car, and that premium may not be long term.
Right.
It could go away if tariffs go away.
Right.
So take out a lease, and then you could always buy into it, and the rates actually look better. It's just there's just small nuances, and you just want to make sure you're doing things in the right order, and it's not putting things on a credit card if it's not an absolute emergency.
Right.
And to go back to that emergency fund, probably having a little bit more than 3 to 6 months. If you're in an ideal world, I would recommend at least 9 in this environment. There's a lot. If you need a new HVAC system, you need a water heater.
I did that last year. You and I talked last year when mine blew out. I was like, oh my God.
Yeah. So there's a lot of things, and it's very specific. But just to start, make sure you're budgeting for any of your big expenses. And even if you don't have to not take vacation, but just make sure you budget and plan for it.
Yeah.
You still got to live. You still want to enjoy, but you also want to be smart.
Yeah. So, have a question. Someone came up. Where do you keep the emergency fund?
So, I always have clients keep at least 2 to 3 months at their bank. And then anything beyond that, I can usually get a better rate than whatever the bank's paying.
Right.
So if you have 3 months at the bank, you can probably buy a 3-month CD for the other portion to lock in that rate. That CD mature in 3 months. And now you have access to a new pile of cash.
Right.
If you don't know, a CD is pretty much a contractual obligation with the bank that
Mm-hmm.
you're going to allow them to utilize that money for 3 months.
Yeah. And I know one of the things that you've taught me, and I know you probably like Michelle, get with it, is the amount of money you have in the bank versus versus in accounts. I'm getting
Mhm.
there. I'm getting
Yeah,
there. I'm getting there. I'm doing better. I'm doing
yeah,
better. Okay.
yeah.
With your guidance, your sound advice. Okay. So should people continue investing during economic downturns? And if so, what strategies do you recommend?
Um, and yes, absolutely, I will continue to invest. The
Mhm.
strategy is, and you've probably heard it before, dollar cost average, which is you taking however much you can afford a month, $300, $3,000, and you consistently invest in high quality investments, and you diversify, and you
Mhm.
continue to do so regardless of where the market is.
Mhm.
Just because the market was high and things were going well doesn't mean you should stop when it starts to turn in the direction. Because what you're doing, if you buy while the market is going down, you're just buying more at a lower cost, which is actually
Right.
to your advantage.
Right.
I when I was I say much younger, but I used to dollar cost average gas. So
Mhm.
if I had $40, I put $40 worth of gas in my car, regardless of what the gas prices were when I was in
Okay.
college. So,
Okay.
there's things that you can control, and there's things that you can't control, and you can't control the cost of gas. You can't
Right.
control groceries. It may be the same approach where you take the same amount of money to the grocery store, and unfortunately, you're going to have to compromise on what you take home.
Right.
So, that's a strategy to consider in
Okay.
that.
Okay.
But to answer your question again, just pick an amount of money you can afford to set aside and continue to invest it and find quality. And it may
Mhm.
require a professional of some sort to assist you with that.
Yeah, and I know one of the things I know we've talked about is not running, pulling your money out when you see a downturn,
Right.
right?
Yes.
Yeah,
Yeah.
which is very tempting to do because you're like, oh,
Mm.
I'm losing lots of money right now.
It's very tempting. I was actually listening to a podcast, and an analyst mentioned that 20% of your returns last
Mhm.
year didn't happen throughout the course of the year. It was from probably the 10 best days of being invested in the market.
Okay.
Markets open about 220 days a year. If
Mhm.
you were sitting out for, I guess, any of those days,
Mhm.
you didn't have a 20% or 24% return.
Right.
So it's very important that you not miss those best days, and you can't time it, and you don't know. So it's better to just stay invested. And that's what I
Right.
think
So
about this market environment.
yeah, so riding it out and thinking about it more so from the long term versus short term perspective.
Absolutely.
See,
Because
I
you don't know
learned
when your
something.
day is going to be the day.
I'm listening. I've been listening to you, Jonathan. Okay. So I know I have quite a few friends in my circle, and some of them are on this call who are thinking about retirement, right? So how should people adjust their retirement plans if they're worried about market fluctuations or recession? Whew. Y'all hang in there with me. Looks like Jonathan has frozen. Let me text him. Jonathan, I don't know if you can hear me. Okay, he's coming back on, y'all. Okay. You
Wow.
froze. I
No, I can hear you though.
told you
It
you
was
could hear me, but you couldn't hear. Okay. I
way
told
back.
you it might happen. Just come on back. Just come on
Yeah.
back. Okay, so I'm going to say
Um,
the question. Did you hear my question?
I did. I've heard everything. So
Okay.
it's it's a very pivotal time. It's actually, in terms of retirement or making that transition, retirement starts years before you actually exit the workforce, because
Okay.
you have to, in my mind, you need to have a buffer so that you're not having to pull from your portfolio right now when the market's in fluctuation or it's
Okay.
in a dive. That could change how long your money actually works or is there for you. So
Mm-hmm.
as if you pull at the wrong time, or if you're pulling in a downward market, then it can cut your retirement years short in terms of funding by 5 to 10 years, if not more.
Okay.
So to answer your question, what I would consider doing is revisiting how much money you have in the stock market and how much money you have in conservative investments that are not exposed to the stock market. And you want to make sure you have, I would say, at least 3 years worth of your actual spending that you want to do in something
Mm-hmm.
conservative.
Right.
That that money could, at this point, given the interest rate environment, you could have money in a money market, you can have money in
Mm-hmm.
CDs, you can have money in, these are fixed income or conservative investments. Um, but you want to make sure you have enough money to where you can draw conservatively and not
Mm-hmm.
have to worry about the market fluctuation or not be affected by it.
Right.
But even with that, again, it's going to be important, I think, to partner with a professional, because not all conservative money is good money, because
Right.
interest rates can also impact it. And you can lose money because of interest rates. That's
Right.
what we experienced back in 2022 with the bond market.
Okay. I was
And
going to say, give an example of that. Yeah. So bond market.
yeah, so
Okay.
just big picture, if you were, a bond itself is a contractual obligation with either a corporation or a municipality. A
Mm-hmm.
municipality is going to be like a state department. They may say, hey, if you give me $10,000, I'm going to give you a 4% return on your money. Everybody wants your money, by the way. So they're
Right.
going to give you a 4% return on your money. And now you're a lender. At a certain period of time, they may say, hey, we're going to give you your money back. And this is agreed upon up front. They may say, we're going to give you your money back in 2030, or we're going to give you your
Okay.
money back in 2050, but we're going to pay you income to allow us to borrow from you and use that money.
Mm-hmm.
If you have high interest rates, a bond that's due in 2050 is going to lose a lot of money.
Mm.
The value of it changes, but the obligation or the contract that you have with that institution does not change.
Right.
And their ability to pay you back is going to be based on their credit paying ability. So same way you have a credit score, municipalities and corporations have a credit score.
Mm-hmm.
That can also affect whether or not you're losing money.
Mm. Okay.
So there's a lot of nuance to it. I don't want to dive into it because
Yeah, yeah. Well, that's when someone will need to
Mhm.
call you to talk about that even more. I know we talked about CDs as well, which appear to be safe. They get a little bit more interest than you would your standard savings account, right? But I know even with that,
Sometimes.
yeah,
Mhm.
yeah. See, a question from many says, if you are close to retirement, do you recommend moving money into the less risky options?
Ooh, it depends on what that less risky option is.
Okay,
You could put money in a bond, and in 2022, you were losing money in that less risky option.
right. So what you were
So
saying earlier.
correct. So it's
Hmm.
important to understand what this less risky option is.
Hmm.
Um, and when in doubt, your less risky could be cash,
Mm,
because that's not going to change. You're going to lose money by way of inflation. So if the
right,
cost of living goes up,
right,
then that 100,000 or that $1,000,000 isn't $1,000,000 or 1,000 once you have to pull it out and spend money.
right.
So again, that's why I think it's vitally important that you work with someone that understands these things,
Yeah.
so that you can properly navigate and do the right things in the right order.
Hmm. Okay. Thank you. Keep the questions coming, y'all. Um, what's the best approach to managing or paying off debt when money is tight? What do you recommend?
So there's good debt and there's bad debt.
Okay.
So student loans are actually considered good debt because they can
Mm,
increase your long-term income. A
okay.
mortgage is a good debt because it can appreciate over time, or even like a home equity, it can improve. You can use it to improve on your HELOC or home equity line of credit. It can improve the value of your home.
Okay.
Some of the things that are bad debt are credit cards and vehicle loans. So
Mm,
what you want to do is you want to attack that bad debt first, and you want to attack the highest interest, because
okay.
you can have a low balance, but if you have a 45%, 30% interest rate on that low balance, it can snowball and compound to where you owe more on this low balance at one point in time. Now it's the highest balance item you have.
Right.
So you
Yeah.
want to cut your bad debt and cut the high interest first.
Okay. All right. What should people consider when deciding when to claim Social Security or pension benefits? So this one is for our retirees,
Ooh,
right? So, and I know, I'm in this space. So I know, you know, ideally, of course, you get more the longer you wait,
right,
right?
right.
But talk a little bit about that.
Yeah, so I'll give you a checklist that I usually go through mentally when I'm assessing a client's social security strategy. And I
Okay.
have tools and software that allow me to be more precise with what I'm doing. But what I always
Hmm.
think about is how much that client has.
Right.
How much money do they have? How much income do they need? Right. I do believe that Social Security will be around. I think that the full retirement age will be lifted. I think that the minimum age could be changed. I
Hmm.
think there's a lot of things that could change or levers that could be pulled to make sure that Social Security is around. But
Okay.
again, the first thing I look at is how much that client has to live on. Do they actually need the income? Do we need to start at age 62?
Right.
And we find money to float them until they're age 70,
Okay.
which is the maximum age at which they can pull it.
Hmm.
Um, if you decide that you want to draw it as soon as possible, one thing I would have you consider is whether or not you plan to work. If
Yeah,
you
that was a
decide
big
to,
one. Yeah, that's
that is,
huge. Yeah.
because if you decide to draw your Social Security before your full retirement age, Social Security will withhold $1 for every $2 you make. That's a 50% penalty or tax, or however you want to think about it. It's 50%.
Mm.
If that income
I
is
don't think,
more
wait a minute.
than
I didn't think I heard that before. I knew there's a certain amount that there's a certain amount you can make if you decide to be employed, right? And I think that's been lifted. I remember it used to be 19. What is it? Is it
it's
19
20,
still?
I think it's 22,100 if I'm
Okay.
not
So
mistaken.
if you pull Social Security and you decide to work a part-time job or do something, you can't make more than 20. What happens if you end up making more than that? What ends
If
up
you make
happening?
more than that, every
Mhm.
dollar above that, the government withholds $1 on every $2.
Wow. Okay, so it's $1 on every dollar. Say that again. Just repeat it. And I'm listening for
So
myself
if
too. Go
you
ahead.
yep. So if you make $2, they're gonna keep one of them.
Okay. Okay.
So you want to make sure that you're not making more than 22. I mean, it's I think a number that's easy to stay below. But if you're just tired of working and you want to start drawing your Social Security, you have to keep in mind whether or not the amount you draw from Social Security is
Yeah.
enough to keep you below that income limit,
Okay.
because the
Yeah.
penalty is high.
Yeah, it's very high. You and I need to talk. You and I need to have a follow-up conversation.
Yeah.
Yes. Okay. All right. Any questions around looking at my questions here? I don't see any new questions. Okay. So, are there any tax efficient strategies that can help people maximize their savings and investments for retirement. And you kind of touched upon this a little bit earlier, but go a little deeper for us.
There's the tax structure as it stands. Their taxes are historically low, right? Mm-hmm. They're lowest that they've ever been. And they're likely to go up. And the reason they're likely to go up is because our debt is going up. Mm-hmm. So to keep us afloat, the government at some point in time, they're going to have to raise taxes, which means they're going to have to tax us more on our income. So I think it's ideal. And I think a way to maximize your savings is to pay taxes now and contribute either to a Roth 401k or a Roth IRA, or simply pay tax on that money and have it in a brokerage account that you pay taxes on annually. Mm-hmm. Those taxes by way of 1099 or interest, similar to what you may receive from the bank. Right. Reason being is if you have that money in a brokerage account, that's where you haven't deferred taxes. $1 million is $1 million because you've paid taxes on it. In a Roth 401k or a Roth IRA, $1 million is more than $1 million because the way those operate is you don't pay any taxes on the money that you earned inside of those accounts. Mm-hmm. As long as you draw after the age of 59 and a half. If you have money in a 401k or any type of retirement account where you've deferred taxes, deferred means you didn't pay taxes on it. Right. So the government's allowing you to not pay tax, but when you start to pull from those accounts, you're going to pay taxes on it. And that's going to be based on how much you pull out. That amount you pull out is seen as earned income. It's taxed in the same way that your earned income may be taxed.
It's considered earned income.
Correct. So if you pull out $100,000, it's as if you earned $100,000. If you pull out $250,000, you're taxed as if you earned $250,000.
Got it.
That's in a single year annually. So in essence, any money you haven't paid tax on, if you have $1 million in a 401k, it's really not $1 million because you haven't paid taxes.
Got it.
So that's why you want to consider those three other options that I mentioned to you. Another one that you may or may not have access to, and this is going to be based on whether or not you have a high deductible health insurance plan, is a healthcare savings account. This allows you to put money away and it grows tax free. And when you pull that money out, it can be used for healthcare expenses. Without any type of taxation. This can be used for Medicare premiums. This can be used for long-term care premiums. Again, this is you essentially creating or deferring tax. Actually, you're doing away with taxes because you don't have to pay taxes on it ever as long as it's for a qualified health expense. So now if you start that at the age of 30 or 50 and you work some more years and you max it out, you got a bucket you can pull from for your healthcare expenses when it's going to cost you the most in retirement. And never have to pay tax on that money.
So the key is not to withdraw anything until you're at least 59 and a half. Correct?
From which account is this?
So you tell me, which account is that?
So 59 and a half is when you have access to the Roth IRAs, the 401ks, all those accounts without a penalty. The HSA, you can pull from that. You can be reimbursed from your HSA anytime, all the time. Right. But what you could also do is you could use your HSA as a stream of income in retirement. If you keep all your receipts over the past 30 years, you can submit them all for reimbursement.
Got it.
So every year, if you spent $10,000 and you had $10,000 in your HSA, now you can ask for $10,000 a year that you've accumulated. There's a lot of nuance to it. And
no, but it's something for people to think about. For those individuals who have the ability to leverage the HSA. If you didn't think about it and you didn't know what it was, now you know what it is and potentially how you can leverage it. Or call a financial advisor so they can help you understand that better.
One other thing I'll add to that is many of you maybe have access to when you're doing your open enrollment, a DCRA. Yes. This is a dependent care reimbursement account.
Yes.
If you're married, you can be reimbursed up to $5,000 of child care expenses if your child is under the age of 13. My wife and I use it. We spend almost $20,000 a year on healthcare. I mean,
I can imagine.
Dependent care expenses or to the daycare. But we get 5 of that back.
Okay.
By utilizing this type of account. So if you have access to it, definitely utilize it because that can save you money and put more money in your pockets when it comes to creating that emergency fund or whatever it is.
It goes back to even 401k. I know some people who have not leveraged it to its fullest. I know one of the things as an HR professional, my background, I tell people at minimum, save the max that you can save in terms of the match, right? So you're getting full benefit of the match, right? So kind of look at what your company has available to you so that you can do more with your money or take advantage of your money, right? So understanding what your company offers, right? Yeah.
Absolutely.
Okay. What are some common financial mistakes people make during uncertain times and how can they avoid it?
Unfortunately, sometimes people don't have enough savings in place.
Okay.
And they go into their 401k and they take a loan. If you're able to do so, it's you stealing away from your future.
Right.
It's unfortunate, but sometimes people do it. But I've had clients have to come to me and what I help them do is find money outside of that so that we're exploring all the things except the worst case scenario, right? Because we don't want to go into that. I think people not paying attention to the interest they're paying on any type of loans they have.
Right.
Those loans, or even if you have credit cards, those rates may have been 15% 3 years ago, 5 years ago. But if you never paid it off, you're now paying over 30%.
Yeah, it's ridiculous.
Because that rate changes.
Yeah.
I would say those are the biggest things, just not understanding the interest that you're paying. And if you don't understand the amount of interest you're paying on a loan, you're liable to let it sit longer than it should and not have that sense of urgency that you would need to have for that financial security that you seek.
Right. All right. So my last question, but you may have some other things you might want to share. So if you could give just one piece of financial advice to someone worried about their economic future, what would it be?
I would say if you're worried about your economic future, if you're doing the things to put yourself in a better position, you'll be fine. I would recommend saving at least 10% of your income and having it to where it's automatically resetting every year by 1%, 1 additional percent.
Okay.
In an ideal world, if you could save 20% of your income, you're going to be fine. Also, I would say the star or the asterisk on that is it depends on how old you are. You want to stay invested because you never know what day may be the day that your account jumps, or you contribute to that 20% that I mentioned that you would have got last year if you missed the best days. Making sure you're budgeting for those big purchases, budgeting for those vacations so that you're in control. And not watching the news as much. If you can really sit and think about it, they are a for-profit entity and your attention is what pays them. So you have to turn off the TV and you have to ignore it. You show up to work, you continue to invest, you stay invested, and control the things that you can. Just buy quality, keep investing again, because with the market dropping, you're buying more at a lower cost.
Right.
when the market returns, instead of you having bought all this at a high rate, it's just going to help your returns. Also, if you're making contributions, it helps your overall return. I gave a lot, but the one thing I would say is control what you can.
Yeah. And when you're thinking about, I think for me, and once I started talking to you, and it's been about 6, 7 years when I met you at a workshop, one of the things for me that made me really think about, okay, I was planning for my longer term future, which I knew I wanted to retire early, and I was able to do that. Right. So kind of have that long term goal in mind. Um, if you're talking about investing and things like that. But like I said, in this economy right now, people may have some short term things that they're trying to just manage day to day.
Right.
Right.
Yeah.
So just being able to talk to somebody who can help you navigate in these waters that we're in right now.
Right. I would highly encourage people to find someone that can help them prepare for today, but also to plan for tomorrow. Because short term and survival is real, but you also can't think of it as you only live once and just negate your future, because you're stealing from your future self.
Right.
And I'll say the one piece of advice I would give people, and this is something I've adopted recently, is anytime I go to make a purchase, I ask myself, what is it going to cost me? And that cost is not monetary. If my goal is, to your point, if you want to retire early, how much is it going to cost me? How many more years is it going to cost me? How many more hours is it going to cost me?
Yeah.
So everything has a cost. There's a trade-off for every purchase you make, for the time you spend. And you really have to weigh whether or not, if you're killing yourself at your job, if it's worth your physical and mental health.
Right. Yeah. Well, I appreciate you. Like I said, I think when many of us came into this year, I know for me, like I said, I had kind of set some goals for myself and things that I wanted to do, and just looking at everything that's been going on. Like I said, rethought how I'm spending money. Like, do I really need to spend money on that right now?
Yes.
Right. And like I said, you've been a great help in terms of just keeping me focused on, Michelle, don't panic. Don't panic longer term. So I appreciate you. People get in contact with you. I know I have your bio, so I will make sure that I repost your bio, so your information is there. Y'all, he's not a social media crazy person like some of us are. So email and your phone number.
Email and phone number.
Yeah, email and phone number, and I will make sure y'all check out his bio. If you follow me on Facebook, my business or my personal page, that information is there. I will make sure that I also get it on my the YouTube channel in case people are watching via YouTube. I'll try to figure out a way to do that. But why don't you say it also? Your phone number, people reach you?
Yeah, it's 919 967 0700.
Okay. And you did mention 23 states. You're in 20, you can help people across 23 states. Is that what I heard you say?
Yeah. At the moment, yes. And that, easily it changes day to day. It depends. Somebody's in Hawaii, then I have to get registered in Hawaii, and it takes me maybe 2 days to do so. So
Got it.
It's easy.
Okay. All right. Well, I'm going to put you in the green room. If you can just go there before I log myself out. But y'all, thank you. Hopefully this was helpful to those of you who needed this information. As I said, when I first kicked off this series, Strive to Thrive, what I had in mind was the things that people tend to focus on the beginning of the year. And that is our health, our finances. I have career coming up. So may have to pivot. We're definitely in some uncertain times right now. But make sure that you're tapping into people who can really, really help you. So my next episode is going to wrap up this series of Strive to Thrive. And I have some very special guests joining me. And the topic is passion and purpose. And it's going to have a career focus, you all. So look forward to seeing you. The date is April 24th. Stay close to my social media pages. And I will make sure to post a save the date as well as the link so that you can see when we will be going live. All right, I'm getting tongue tied. But anyway, see you soon. Thank you all for tuning in. Have a blessed week, rest of your week, and happy spring, y'all.
Bye.